Oh hey, so here we are, part 2 of our ratio analysis. Formulas, whatever. So we did solvency ratios, which were essentially sort of what situation is the company in, what risk is it in right now. And now we're going to move on to the rest, which are a couple of different kinds. So we'll look at those first. Again, you need to be kind of, right here on my website. You need to grab the ratio formula stuff, and if you want to follow along with maybe some of the numbers, grab that too. But essentially, you need this. So not unlike last time, essentially this lesson, although much shorter this time, is just going to talk about sort of what the ratios are, some tips about interpreting them, so that when you do your analysis, you can put it all together and start to make sense of the numbers you're looking at. I'm not going to spend a lot of time with the formulas, because essentially if you could do the first ones in the last lesson, you can do these ones, right? So if you take a look, what we have are two types, okay? So right here is borrowing capacity. So essentially these are measuring your ability to handle the debt you have and maybe even take on more debt. And then if we kind of, go down a bit to, here we are, this is all basically efficiency. How well run is your firm that you're analyzing, right? So you've got sort of a return on the assets you've got in the business, cash soaked in your assets, essentially long-term assets, but all of them. What kind of return you're making on your wealth, right? The equity you have in this business, and how well are you able to turn $1 of sales into profit? How much of every dollar of sales becomes profit? All of these measure how well basically you're running your business, as well as some of the market conditions you're facing that determine whether you're inefficient or really efficient, because that has an impact too. There's only so much you can do as owner or manager with your business in the face of certain market conditions. So let's take a look at this one, debt ratio, right? The debt ratio can be really different. For example, Apple Incorporated has almost no debt, and it's an enormous company, one of the largest in the world. And then other companies have tons of debt. So this one, as you can see right here, says that you should have ideally no more than half of all your assets, equivalent of your assets, in debt. But that's really rough. It depends, it's just a rough guideline. It depends on the industry you're in. But clearly, the more debt you have, the harder it is for you to borrow more, because you have to pay interest expense on debt, right? And the more debt you have, the more at risk you are from not being able to pay that debt, especially if the rate of interest goes up. You're very exposed to interest rates if you have more than 50% of all assets, if that's the size of your debt, right? Your long-term debt we're talking about. You certainly shouldn't have 50% in short-term debt or you're in big trouble. Next is times interest earned. Now, we do need to explain this one. If you look carefully at this formula, the numerator is this thing called EBIT or EBITDA. So, with times interest earned, it's measuring how many times over you earn your interest expense. So it's essentially coverage. It's very much like the current ratio, right? How much bigger are your current assets than your current debts that you have to pay the next year? This is saying how many times bigger is your profit than the interest expense that you've got to pay coming out of those profits, right? You don't really pay interest with profits, you pay with cash, but same idea, right? Profits drive cash flow. So there is something different about this though, isn't there? You've never seen this before. This is earnings before interest, taxes, and amortization. And there's a reason for all of them, right? Reason why you use the earnings before any of them. And the reason, quite simply, is you deduct interest from your profit before you pay tax. 2, your taxes, because they're paid after you pay your interest costs, right, are not, the government doesn't just say, okay, you have to pay us $50 million. If your interest wipes out all your profit, you don't owe the government anything. Right? So you have to take that off. You have to see what the profit is before any of these other things that you don't necessarily as management have control over. And amortization, of course, you take that off because that doesn't use cash. It lowers profit but doesn't use cash. So you want to see, it's kind of a quick way to look at, here's my profit that's actually cash profit before the government takes anything and before I pay interest. Because what that actually is the amount of profit or money really that you have to pay the interest expense. That's why you use that one. Let's go down then and look at these ones, right? The first one being, of course, our return on our assets. And that's simply operating income, right? So the money we make from our regular operations. Again, this is going to require you to go back maybe to the cash flow statement, but probably you should find it in the income statement. But it's going to be a little bit above. It's not going to be the last line. Okay, it's going to be before interest expense and a few other items. So operating income divided by, look again, average assets. That means you have to take last year's ending assets and this year's total assets and divide by 2. Right? Same with average equity down here. Okay? So what this is going to measure is basically, it's telling you, and this is why these are called profitability or efficiency ratios, it tells you how much of all the cash you have soaked in, all your wealth sitting in your assets, how much of that are you able to return as profit? Right? Because the higher the number, the more efficient you are. You can generate that profit with less assets. Right? So think about it. Let's say you had $100 million of assets. That's the book value of your assets. And from that, you made $1 million. That's a 1% return. You have a huge amount of wealth sitting in assets to only make $1 million of profit. Right? Only $1 million of wealth creation from that. If you only had 50 million sitting in assets and you were still able to make $1 million, you're twice as efficient. Right? That's a 2% rate of return on your assets. All of these ratios measure the same thing, just slightly different. The next one, right here, return on equity. That's simply all your profit, so all your wealth creation, not cash creation, but wealth creation, as a percentage of your outstanding equity. And once again, same reason as inventory turnover, accounts receivable turnover. Net income is a year-long number, and ending equity is just a snapshot, like a second in time. So we try to come up with the average level of equity over the year, right, by using the average equity. Again, that's beginning equity, or last year's ending, same thing, plus this year's ending equity divided by 2. And what it's going to tell you, same sort of thing. If you have $100 million of wealth in your business and it generates $10 million of profit, that's a return on your wealth, it's a return on your investment of 10%. That's pretty good. But if you can return 15%, so in other words, if you could have less wealth in there and still earn $10 million, your business is more efficient, it's more profitable, right? It's a higher return on your investment as a shareholder. So it's essentially, these are all the same. Same thing with return on sales, right? If your net income divided by net sales is 15%, that means you turn 15 cents of every dollar from sales you get to keep as profit after tax, right? So that is your ability to turn $1 of income into profit. How much of it into profit? So all of these essentially are measuring efficiency. Now, here's the warning. There are industry obstacles. There's things going on out there in the economy that will cause some companies and industries to have trouble. But what these ratios, particularly these 3 ratios, tell you right here, right, our return ratios, is they're giving you a little bit of insight into how competent management is, right? Because you can't learn everything about what's going on. Companies have cultures, right? They have ways of doing things. Some companies that are more timid, they're run by people that are maybe remember bad times. They like to keep more assets on hand to be safe, or more cash in their business, right? Apple Incorporated, perfect example. Apple has more liquid cash than some banks, right? Tons of it. In the years 2012 and 2013, Apple came under a lot of fire because it didn't pay a dividend, didn't pay even a significant dividend, and even when it did, it wasn't that large, and people still got upset because they had all this cash, which of course belongs to the shareholders, that's who owns the company, and they wanted that cash back if Apple wasn't going to use it, right? That's a culture of, we need to hang on to this cash, far more than they could possibly use in research and development, and they just hung on to it. So their return on assets would not have been that great, because the denominator would have been huge because of all that cash. So that would show up in this ratio for Apple. Right? Likewise, if companies had all of these, bought way more assets and had way too much inventory, all that would show up here too. So if management was making silly decisions, right? Making stupid choices, was running things very poorly, if their net income was low because they were being very wasteful, right? If they had raised all sorts of equity from issuing new shares and they had all this equity, but they weren't able to turn it into profit.
It's 4 o'clock.
It's 4 o'clock, by the way. All of this would show it because you'd have low returns on either assets or low returns on equity, or you would just show that your sales, see down here, that every dollar of sales you weren't able to turn it into much at all. You might have a return of 1% or even a negative return, which means you didn't make profit, you made a loss. That's essentially how it works. So you have to throw all these together with the ratios last time, which were situational. How safe are we right now? This tells you how much more can we borrow and how can we handle the debt that we have, combined with how efficient are we? How well do we kind of run this business? How well are we able to generate wealth from our assets and the equity or wealth that we have invested in the business? So when you put all those together, you should be able to spot, again, trends or things that stand out, and you should be able to measure up the firm you're looking at with another firm or with the industry that the firm is in, and then decide whether this is a good company, a company in a good position that seems to be going downhill, a company that's in a good or bad position that seems to be improving, or whatever.